Hi, good evening. We will start the session shortly. We are just waiting for a few more guests to join the session. We shall start in a couple of minutes. Hello, everyone. While we wait for the formal session to join in, would you like some of you, can you just introduce yourself so we get to know each other? KSK, would you like to introduce yourself? Oh, okay, KSK, got it. So, Angel, would you like to introduce yourself? Angel or Chalapati, if you can hear us. Josefa, Lavish, any one of you? If you can just introduce yourself, I think the session will be a lot more interesting.
Hello, Pradeep. I am audible, Pradeep.
Hi Pradeep sir, Huzaifa here. I'm sales executive at ANAX Capital.
So you're on mute, Sir Pradeep, sir.
Okay. Josefa, got you. Heard you.
Hello. Hi, Pradeep. Good evening.
Good evening. Good evening. Go on. We can hear you.
Yeah, thank you. I just introduced myself. I am Chalapati, living in Chennai. So I am working with maybe in private concern as a treasury department. So we're excited to go on this session, Pradeep. Thank you for the
Thank
more
you.
sessions.
Chalapati, by any chance, do you trade, invest in the foreign exchange market?
No, unfortunately, no. So just wanted to have a glimpse on the session today.
Perfect. Welcome. Welcome to the session. You can go on mute.
Thank you.
Sunil Kumar, Shabina, Sabir, any one of you would like to say hello? Or Shivanshu?
Hello.
Hi, good evening, good evening.
Yeah, good evening. Good evening, everyone. Sorry for the delay. There was a bit of glitch on my laptop and I was not audible. I was trying to speak. Thank you, everyone, for joining today. I would like to begin this session with a short introduction about myself. I am Mithil Kapadia. I am working as the Chief Operating Officer at ANAX Capital, and we are an ASCA regulated broker based in UAE. We are very excited to welcome everybody of you over here for the very first webinar that we are going to start from today, and it's going to be an ongoing process. We are looking to our mission of this webinar is to educate, empower, and engage with traders and the market enthusiasts like you who have joined us today. Annex Capital stands for trust, transparency, and technology. Whether you are new in this market or experienced, our goal is to offer you the tools and the support you need to grow with confidence. With all that, I am very pleased to announce Mr. Pradeep Chandrasekharan, who's going to be our speaker for today. We are going to cover today in our webinar topic about technical analysis, which is focused on moving averages today. So we're going to give a very basic overview of moving averages to all you traders. And over to Mr. Pradeep. Thank you very much.
Thank you so much, Mithul, and welcome once again to all of you guests. So I was so happy when a few weeks ago, Mithul and I were talking on, what we can do differently to engage with the traders. And the first thing which came across both our minds was the need to educate, traders and investors. Because as you will see, as we progress through this Trading Master Series, you will realize that whether it is the forex market, whether it is the commodity market, the crypto market, or the stock market, it is a knowledge which is going to define your success or your failure in the markets. So this is very, very important and a great initiative which Annex, Annex has started off with. And today, what we are going to do is we are dividing this moving average into a couple of parts. And today I'll take you through the basic, and in the forthcoming session, we will discuss a couple of strategies which you can easily adopt in your trading. What I would request all of you to do is, because this is a very short session, uh, I will request you all to keep your questions till the end of the session. You can also use the chat box in case some of you are outside or you're not able to unmute yourself. Do use the chat box to ask the questions, and we shall definitely answer and address each of your queries before we wind up today's session. So let me quickly start off with the session now. So I would like to start off by sharing with you a Euro US dollar chart. Now you can see that as we look at the chart looks to be moving upwards. But if you can see the lowest part, which is in early 2025, the US Euro USD was trading at around 1.02. That was the lowest level. And today, as I speak to you, it is trading very close to 1.18. But you can see something here. The movement from 1.02 to 1.18 has not been in a straight line. There have been many ups and downs along the path. These are the fluctuations, sometimes we call them noise. And as traders, it's very, very important for us to know when these turns and these movements are going to happen, because it is your ability to read these movements at the right time which is going to help you make your bit of money, right? So what we will do is, with that small preamble, let me straight tell you what is a moving average. So you see, in the financial markets, there is always something called a trend. Basically, there are going to be three trends. There is what is called an uptrend or a bullish trend. There's a downtrend, otherwise called a bearish trend. And there is a sideways trend where the market is not headed anywhere. Now, the important challenge is, how do you identify a trend? How do you know whether the market is bullish? How do you know whether the market is bearish? And the moving averages definitely is one tool which you can use to identify the trend, because in the financial markets, there's an old saying that the trend is your friend. The trend is your friend, never buck the trend. So what does that mean? If the trend is bullish, look for a buying opportunity. If the trend is bearish, look for a selling opportunity. And if the trend is sideways, do nothing, stay out. For example, as I'll show you possibly in the next session, crude oil at this point in time, as I speak to you, is not trending anywhere. It is locked up in a price range between $65 and $69.50. So there's no trading opportunity there. Now, another important advantage of moving averages is, so I just showed you this picture here. So I said that the movement has not been straight. There have been ups and downs. We call that fluctuations. So the moving averages can help us smoothen out these fluctuations, so that you know you are shutting out all what we call noise in the market. So when you clear out the noise in the market, the trend will become very, very apparent. Now, what exactly is the moving average? The moving average is simply an average of past prices, what has happened in the past. Now, there are actually two types of averages. There is what is called a static average. Static average means, if some of you are following cricket, for example, we know that Sachin Tendulkar retired from Test cricket nearly 10 years ago. Now he has scored, about 30,000 runs. He has played about, let's say, 100 or 200 innings. Now, to find his average score, you divide 330,000 divided by that 100 or 200 innings he has played, you get the average score. However, if you take, the current cricket players like a Joe Root or a Shubman Gill, they are still very active as cricket players. So with every innings which they play, the average will keep on changing. Now, in the case of financial markets, that is why we call this a moving average, because it is not a static average. With every passing day or every passing hour, the average will keep on changing. We are going to keep on incorporating newer and newer data as the data becomes available. So you see, in the financial markets, it's a very dynamic place. Every minute of the day, new data is coming. As traders, we have got to process that information very quickly and come to a conclusion whether we want to buy, whether we want to sell, whether we want to stay out of the market. And this is definitely one very, very dynamic tool which is going to enable you to take the right decision. Now, another very, very important point or advantage of understanding averages is that you can also understand how strong the prevailing trend is. Sometimes you will see that the underlying strength is very, very good. So you can confidently go and take a trade. Sometimes you will find that the market is hesitating. So you're not all that confident. But how do you know how strong the market is at any given point of time? Again, the averages is the answer. Now, the beauty of these averages is, if you actually think about a fundamental analysis by which many investors will swear by, fundamental analysis can be used or applied only to the share market. You cannot apply it to the foreign exchange market. You cannot apply it to the commodity market. But the beauty of technical analysis is, whether it is the cryptocurrency market, whether it is the forex market, whether it is commodity market, whether it is the equity market, whether it is futures market, you can apply this. And it is so easy and simple to use once you understand how it works, that any one of us can easily apply it and be very, very successful with it. Now, generally speaking, I want you to understand that in the financial market, there is no holy grail, which basically means that there is no one single tool which I can teach you or anyone can teach you and say that if you apply this one rule, you are going to succeed in the market. There's no such tool which has ever been invented, nor can it ever be invented either. But what the tools like moving averages do is, when you learn how to combine it effectively with other tools and techniques as well, it can actually provide you with an excellent edge compared to your competition. Now, like I said earlier, this moving average also helps us filter out unnecessary noise. It can help you remove or minimize the volatility, the short-term volatility. Very, very importantly, these tools can actually give you an excellent entry and exit point. Now, you would be familiar with the term support and resistance. Support is the place where we expect the prices to stop falling, and resistance is the place where we expect the prices to stop rising. Now, generally when we use other tools like, let us say, a trend line, etc., these are static, meaning you draw it and that is where it stands. But the advantage of using moving averages is, because it is using the current latest data, the support and the resistance lines will keep on moving very, very dynamically. So it is aligned to the latest market action. Now, out there, many people will say that fundamental analysis is used for long-term investing and technical analysis is used for short-term trading. And I will show you that that is not necessarily a correct understanding. Because if you actually learn how to use tools like moving averages very effectively, you can actually successfully use it even for the purpose of long-term investing. I've been successfully using it for more than 20 years to tell you this story. Also, these moving averages can also be used to trigger buys and sells. So we call them, when you learn how to combine one moving average with another moving average, we say that there is a crossover. And the crossovers can signal to you both buying triggers as well as selling triggers. Now, as I take you deeper into this subject, let me first tell you the kind of data which you will require to use moving averages successfully. What I am sharing with you here on the screen is actually a screen grab from investing.com. You would be aware that ANAX provides us with a Meta, and it's a powerful tool. So if you actually reach out or if you have never used it, please do make a use of all the tools which ANAX is providing you. Quite effective. And once you learn how to use these tools very effectively, you can use that to increase your success rate in the financial markets, right? So let me just explain this to you. You can set this up on the Meta, software itself. You can also go to any exchange website. You can get the same kind of data. Now, you can see here that the first column tells you the name of the instrument. So I have brought here in the same screen multiple instruments just to show you that, what I am sharing, what I am trying to share with you can be applied to all free financial markets. So I have got here 4 indices the S&P 500 and Dow Jones from the New York Stock Exchange, NASDAQ 100 and NASDAQ Composite Index are from the NASDAQ, and then gold and silver, which are precious metals from the New York Mercantile Exchange, and also, of course, the silver. And then I've got Brent crude and also WTI crude. That is the West Texas Intermediate. I think somebody's mic has gone off. Can you just mute yourself, please? Because there's an echo coming back. Thank you. And then we have got several currency pairs out there. And that is the column number one. Column number two, whenever it is related to an exchange, which basically means for a commodity, for a stock, and for an index, so you have got what is called a symbol. And the symbol is provided to us by the concerned exchange. Now, in the case of the currency pair, it is the Euro GBP, which is both the name as well as the symbol. So there's no separate symbol to be used for currencies. And then, if you look into the next few columns, I've got the last. Last basically means the last price at which a trade has taken place. Then we have got the opening price, which basically means the first price at which a trade has taken place that day. We have got a high, which is the highest price at which a trade has taken place. The low is the lowest price at which a trade has taken place. Then I've got a change compared, that is, how much the price has changed compared to yesterday's close and the percentage change. And then the volume. The volume basically tells us how many stocks or how many contracts have been traded at that point in time. So these are the primarily out of this entire thing. The most important information we require is open, high, low, and either the closing price, which will be available after the market closes, or the last traded price, which we use as a proxy for the closing price. Now, the volume basically means the total number of contracts which have been, traded at that particular point in time. I just want to re-emphasize the difference between the closing price and the LTP. The closing price is actually calculated by the exchange. It is the weighted average price of the last 30 minutes of trading. And LTP stands for the last traded price. Okay. And then when it comes into currencies, I'm just sharing this information because I'm not sure how many of you actually know how to read what is called a currency pair. So I'm just, explaining to you one currency pair, which is Euro to GBP. So when it is written Euro GBP, the way to read that is Euro, that is the first currency whose name is written. It is called the base currency. And the currency which is written second, in this case, it is GBP. It is called the quote currency or the variable currency. Now, you can see here that the last traded price is 0.8667. Now, how do you read it? So it basically means so many units of the quote or variable currency for 1 unit of the base currency. In other words, it basically means 0.8667 GBP for 1 euro. That is how you read it. Now, if you look into, just go down that first column and come to the last two. The second last one is US dollar JPY. JPY stands for Japanese yen. And the figure which we see is 146.66. So in the USD JPY, US dollar is the base currency. Japanese yen is the quote or variable currency. So basically it means you require 146.66 Japanese yen to purchase $1. So this is something you must always remember when it comes into a currency pair. Now, what I showed you basically was the kind of screen which you will see for end of the day. That is after the market closes. Now we know that in the case of crypto, in the case of commodity, equity, as well as, of course, for the foreign exchange, the markets are very, very dynamic. There are specified trading hours during which you can buy and sell. So you can actually get live data. Even ANAX provides you with, live trading data. So this is a live trading screen. And I thought I'll also share with you a quick screen grab from a live foreign forex trading screen. And I'll just show you one more piece of information which you need to be aware. And that is the bid and the ask. So what exactly is bid? Bid means the best price at which someone is ready to buy from us. So if you wish to sell your whatever you're owning, you can sell it at the bid price. On the contrary, ask is the best price at which someone is ready to sell. In other words, if you wish to buy, you have to bid. You have to buy it at the ask. So if you look at the Euro USD currency pair, the bid is 1.1732. Bid at 1.1732 means if you wish to buy, if you wish to sell, you can sell. You can get only 1.1732. Please take a minute to understand. If you wish to sell, you can sell at 1.1732. But if you wish to buy, you have to pay 1.1734. So from this, something is very clear. The ask will always be higher than the bid. Ask is always higher than the bid. And the difference between the ask in the case of Euro USD, 1.1734 minus 1.1732 is equal to 1.0002. That 0.0002 is called the spread. So always when you're going to be trading, keep an eye on the spread, because if the spread is very, very big, it basically is an indicator that the market is not very liquid. Okay. So if the market is not very liquid, don't try to trade in that. Ensure that whatever instrument you want to trade in, the liquidity is good. Otherwise, when you want to buy or sell, you will suddenly find that you may not get the right quote to be able to make a profit. So that can create a problem for you, right? So how exactly do you calculate a moving average? So let us look at some of the data. So what I've got here is Microsoft data. I've just collated this data on an Excel sheet. You can see that I have taken the data from the 16th of May 2025 and ended with the 22nd of July 2025, which is up to yesterday. You can see here that again, I have taken 5 pieces of data: open, high, low, close, and the volume. In financial markets, please understand, this is the order in which the price always should be collated or collected. Okay, open, high, low, close. Now, when you're going to be calculating a moving average, I want to give you a small warning. Don't try to calculate the average on the opening price or the highest price or the lowest price. Sometimes out there on the social media, some people can misguide you into using or trying that method. Don't do it. The easiest and the best way to apply a moving average is to calculate it using the closing price of the day. So what I've done in the next screen is I have eliminated the open, high, and the low. And you can see I've got only the closing price now. Just concentrate on the date and the closing price. Okay. So you can see that is the data on which I'm going to calculate the average. Now, what exactly have I done here? What I have done here is in column number 4, you can see 9-day total. So you see, first I'm going to calculate a 9-day moving average. To calculate a 9-day moving average, I want you to understand there will be no moving average for the first 8 days. On the 9th day, what I have done is I'm taking the closing price of the 16th, the 19th, the 20th, etc. till 29th, that is column 1 to 9. I have totaled up the closing prices and put that total, and you can see the total is 3,129.11. Now, to calculate a 9-day moving average, it is very, very simple. I divide 3129.11 by 9. I get 347.68 as the moving average. That is how I calculate the moving average. On the 10th day, that is 30th of May, what do? I drop the data for 16th of May. Instead, I start from the 19th, which is 342.09, and go on till the 30th when the price is 346.46. That total is 3,125.59, and divide by the number 9, I get the average as 347.29. I repeat the process every single day. So this is how I calculate the 9-day average. Now, if you're looking into the right-hand side of the screen, on the 30th day, I'm also calculating a 30-day average. So for calculating a 30-day average, you must understand I cannot calculate the 30-day moving average for the first 29 days. On the 30th day, what I do, I take the closing price of the last 30 days, put the total here. You can see the total 8,318.31. Divide that number by the number 30. The 30-day moving average is 277.28. On the 31st day, once again, I drop the data for 16th of May. I start from 19th of May and go on till 1st of July. The total I get is 7,968.33, and divide that figure by the number 30. I get the 30-day average 265.61. So this process is going to be repeated every single day. Now, if I want to calculate a 100-day moving average, I will not have a moving average for the first 100 days. If I want to calculate a moving average for 200 days, I will not have a moving average for the first 200 days. On the 200th day, what do? I take the closing price of the previous 200 days, take the total, divide by the number 200, I get the 200-day moving average. This is how this is calculated and done. Now, I just explained to you the maths behind this. It is very important that as traders, we understand how this is calculated. But in real life, what happens is, when we are using a software, the software will automatically calculate the moving average and draw the moving average line here for you. So in the Microsoft chart, what you can see is, you can see that the red and the green lines, they are basically the price chart of Microsoft, but there's a blue line there, and that is basically the 9-day average. And you can see something very interesting here. Since the late April 2025, you can see that the price has managed to stay above the moving average. In the next class, I will explain to you how to interpret the moving averages. But in today's session, I'm only explaining to you how the moving average is actually calculated. Now, in the next screen, what I have got is a 30-day moving average. First, I imposed the 9-day average. Here, I have superimposed the red line, which is basically the 30-day average. And even in this case, you can see from the end of April onwards, the price has stayed above the 30-day average. And finally, in the final screen, what I've got is I've superimposed both the 9-day and the 30-day average together with the price. So you've got the blue line, which is the 9-day average. You've got the 30-day average, which is the red line. And at the background, you've got the price data as well, right? So this is basically the basis of moving averages. It'll become even more interesting as we move along because, like I have already told you earlier at the beginning, the advantage of moving averages, it will A, help you eliminate the noise. It will help you smoothen out the fluctuation. It will help you identify the trend. You will know whether to buy. You will know when to buy. You will know when to sell. You will know what is the strength of the underlying move. You will know when to trigger, when to be prepared for a potential change in the trend as well, right? So this is what I wanted to touch base with you, cover with you today. And at this point, I'm happy to address any questions which you may have. Please use your chat box to ask a question, or you can, I prefer that you unmute and ask a question. Anyone wants to ask a question? If one person can ask one question, I think everyone else will start asking questions. So who would like to be the first person? I think Divya and Madhu have started a small poll also. So if you can quickly also use that to answer, that'll also make it a little bit interesting. And the question here is, what is the use of a moving average? They increase the noise, they filter out the noise, and the last choice is that they are a distraction. So while you answer that query or the question, please continue to ask your questions. Feel free to ask a question. Can I invite Angel or Ashik? Would you like to ask a question? Arbas?
Yes, I have invited Angel and Ashika. You guys can ask.
Ramesh Kuti, Sabir, Shahan, Sunil Kumar, any one of you, please feel free. I don't see any questions coming in. Uh, Chalapati, you want to ask any questions, Chalapati? Okay, fair enough. Yes.
Yeah, hi, Mr. Pradeep. I think we've already reached out to a lot of people, and we have successfully finished the first part of this. I think we'll also be open, for the next session when we'll roll it out soon, and we'll give them proper time to prepare their questions as well.
Sure.
So I would really like to take this opportunity to thank you for coming over and presenting a wonderful insight about moving averages. And we look forward for participation from all our guests over here for the session 2 as well. So thank you very much, Pradeep. Thank you everybody for joining. and have a lovely evening.
Thank you, Mithul. Thank you, Divya. Thank you, audience,
Thank
and
you,
thank
sir.
you,
Good day,
Madhu, for
everyone.
organizing the program.